U.S. in the 80s and 90s, Japan is an economic enemy, wanted to halt its expansion to grow bigger than the U.S. You better get your last chance to go to Japan where the yen is still on sale.
That's amazing. I remember
Japan is turning. Trump, despite his voice, his policy favors the wealthy. His tariff-driven agenda might support U.S. manufacturing and the blue-collar workers, but net, his corporate tax policy, etc., actually favors the wealthy. Harris and Biden, Treasury Secretary Yellen, it's clearly an element of social program that's involved. I mean, that's the way their stance is.
To all the viewers from the United States, Korea, and around the world, welcome to Global Money Talks, reporting from the floor of the New York Stock Exchange. I'm your host, Tai Wong, and you're watching TV's special Global Launch Edition interview with Jae Yoon, the Chief Investment Officer for New York Life Investment Management and Chairman of New York Life Investments in Asia. Prior to New York Life, Jay was a managing director at Merrill Lynch and JP Morgan. He holds a master's in engineering from Cornell University. He is also a CFA charter holder. Jay, thank you so much for joining us today.
Yeah, thank you. I appreciate you inviting me.
I was glad to have you here. So, can you give us an idea, give our viewers an idea of what you do as a Chief Investment Officer for New York Life?
Yeah. So, for many of the Korean investors, I've been on Sampro in Korea, so in Korean, so they're somewhat familiar, but for now that we're opening, congratulations, you're opening the show now to the US. So I'm very happy to speak in English. Unfortunately, English is my better language, and my American colleagues would tell me then that's a problem. As a CIO of New York Life Investment side, I have multiple roles actually. 20 years I've been in this company, so I've had various roles. But we're multi-boutiques, so I oversee, govern our multi-boutique program. Responsible for, setting product, new strategy, seeding them, governing the way they're managed. However, I don't interfere with their investment view. They have theirs. And at the same time, I actually manage my own multi-asset macro fund. So I have my own team. When I first started out, I was, every day trading it. Today, I set monthly policies. I let them get on with their tactical trading. So I have that piece. So the governance, the investment piece, and the third piece really developed partly because I used to travel around the world talking to clients. And that led to, during COVID, taking over Asia. And Asia is much more of a client business. So I started to chair officially the Asia business development. So Korea, Tokyo, or Japan, and then Southeast Asia. Southeast Asia, we're still developing it.
So for our viewers and for myself, actually, I don't know very much about the insurance business.
Yeah.
Are you responsible for the part of the business where, people pay premiums and you manage to make sure the liabilities match what your asset? Is that part of what?
That's a great question because I get that a lot. I get a lot of insurance questions, and I remind people I am not part of the insurance business. Right, I'm in the business of investments. That includes money that what you call when a person buys insurance premium and they pay the premium that needs to be invested to the day that something unfortunate happens and we have to pay them the payout of the life insurance policy. So I'm involved in investing of that money. But if you ask me how a whole life or these insurance policies work, you got me. I know enough to be dangerous.
So, without giving any proprietary information, how big is it okay to ask how big the portfolio of New York Life?
So broadly, including clients' money, we have 750 billion in AUM. And actually, the third-party client, that's where someone gives us a mandate to purely invest for them based on some benchmark or profile. That's larger than the New York Life general account. That's where we collect premiums. Yeah.
Really? So there are folks who will actually say, come to New York Life and say, we would like you to invest, this portion of money. What are they? Pension funds? Are they?
They're sovereign wealth, pension, all types. So we actually have the general account, where premiums come in and we invest it. And then we actually have a dedicated third-party business. Now we're multi-boutique. So underneath the New York Life Investment brand, we actually have 8, well, it goes up, different brands where they're dedicated companies. Some of them we created from organically, others we purchased along the way. So I think first purchase dates back to the 80s, 1980s. I mean, before my days at New York Life. Been here 20 years, but there are some boutiques that predate me.
Oh, so it's almost a different name than New York Life, or are they all New York Life?
They have their own brand names.
Oh, I see. Yeah. Any of those that people would recognize?
Oh yeah. So Mackay Shields is a famous one. Near Central Park. Candrim in Europe, or Real Estate Tristan. There's 8 of them, so I won't list them all.
Wow.
Yeah.
Wow, I didn't realize that's such a big part of the business.
So there are a few firms that apply a multi-boutique model, and we are one of them. I am the only investment team that sits inside the parent company.
I see.
And then I allocate to them. So I actually not only govern them, but I actually allocate money to them. So I'm quite intimately familiar with their strategy.
And so how often, if I might ask, how often do you allocate? Is it an annual decision? Is it a biannual decision?
Yeah.
I'm sure it probably changes. But
So that's a great question. So the insurance companies, a lot of people go, he's an insurance company guy, so he's very long term. So the insurance companies clearly long term. They measure things in multiple years and decades, right? The asset management business, you don't get the luxury of being patient. Investors don't remain that patient. So we're usually measured with a 3-year window. Right? How's your 3-year track record? So when we invest, we're investing probably with a horizon of 1 to 2 years or longer. And then you have the tactical aspect, right? When markets, like last couple of weeks, we actually didn't do much in the last couple of weeks, to be fair. But when markets create volatility, you actually want to be tactical. We've actually put on a trade in the morning and closed it by end of the day during, I recall 2015 there was a week when US got downgraded. Markets went up 5%, down S&P, up 5%, down 5%, up 5%. In that period, we actually did day trade. And I think maybe in 2021, we actually had a day trade. But it's very rare we would actually get in just to get out by the end of the day.
Right.
But occasionally, markets become extremely volatile. Yeah.
And then for the insurance side of the business, you probably have some much longer investments where you're not worried about the daily mark-to-market or the
buy and hold.
Right.
The concept of buying something and not touching it and letting it mature, it happens. There's some 10, 20-year treasury bond that's probably still got the, 8, 9, 10% coupon that's sitting in the books.
We may be going that way again at some stage.
There's just some things that the insurance company, unless you have to trade it, they won't. Yeah, it's a much more of a primary issuance market where you buy something, and chances are some bonds will just sit there for 30 years and mature.
And do I guess competitors, other insurance companies also sort of do multi-asset as well? Or
I won't say we're unique and different. We may be differentiated from others, but we're broadly, there are many other insurance companies that are similar to us in terms of doing mostly insurance company business to mostly third party. We're skewed more 60% third party, 40% insurance money. Our third party business grew faster than our ability of our insurance company to grow their premium. Maybe that's a better way to put it.
Right. That's fascinating. I would never realize. I guess I only saw the insurance part, and you must invest for 30 years and pull the coupons to pay to pay the claims. But that's really fascinating.
Let's put it this way: in the last 10 years, I won't get into names, but some of the private equity, private credit guys, firms, have purchased the right to allocate to an insurance asset, and they are bigger than our general account.
So wait, explain that to me. How they purchased the right to?
The big private equity firms. They have purchased the right to actually invest for other people's insurance assets.
I see.
So I forget what it's called, technical term, but they are the investment advisor for those liabilities.
Right.
Yeah.
Right. That's
Anyway.
interesting. It's I guess everybody's trying to expand their footprint and
Yeah, because
trying
I
to
think insurance investing is quite patient. So if you've got 10, 20-year private, well, 10 plus year private equity or 5 to 10 year private credit, then insurance assets are ideal candidate to invest such a long term.
right.
Now we're getting into retail investors getting into private asset. Private credit runs 3 to 5, some of the shorter maturity. That's still reasonably short enough for private retail to get involved in, and it's quite lucrative in liquidity premium, as they call it, the extra yield you get from public. But the biggest, I think, obstacle that people are trying to solve is the fact that retail investors aren't going to patiently stay 3 to 5 years, right? They want the ability to get out,
Right.
and so we'll find out how well they engineer that. Because it's like going to a baseball game or any kind of stadium. In baseball, it's kind of nice. By 7th inning, you kind of go like, yeah, you know what? Let me get out. Or this game, I'm going to wait till the final pitch, even if I have to all like storm out, right?
Right.
So
right.
I think the thing with going to be interesting is there's such a hunger for private credit, but with retail, when they all want to get out at the same time, we'll find out how that works.
Right. I want to come back to this a little bit later because that's
Please.
a fascinating part of the market, and I want your insights on it. But I think what's top of mind for many of our viewers and many investors is 2 weeks ago the market in the U.S. woke up to a nightmare on Monday, and people were talking about intermeeting rate cuts, and for a short period of time it was really desperate. Now, we've had an aggressive rally in the last 2 weeks, and we're in sight of all-time highs if we haven't hit it already.
Yeah.
What do you think about that? Was this just a blip, or does that signal something that we should be a little more cautious?
It's both, right? I've been long-standing cautious investor in the last 18 months, waiting for a recession to come. Because recession's like 4 seasons in a year, right? America has seen, depending on who you ask, 8 or 9 recessions. So recession and bust and boom is part of U.S. economy. Having said that, it's been a really interesting cycle where 18 months ago we were all expecting, based on the various, I call it dominoes, right? You can see the economy like dominoes fall, like that leads to a recession. But the domino got stopped by the massive fiscal. To be fair, under Trump, President Trump, we had COVID. So there was a massive fiscal to help a global economy that came to a sudden stop. Never happened before. Then I guess when President Biden came to being, usually then economy recovers and you halt your fiscal. Fiscals are usually seen, large fiscals are usually seen during a recovery phase to get the economy back going when it halts from recession. But what happened was, because they didn't know where to stop, they just kept going. In fact, then it became election year, then he wanted to do more. So I have a personal view on that, but putting that aside, so we had this abnormal situation where the economy came to a halt globally, restarted, and we had supply and demand imbalance. On top of it, we had an unprecedented fiscal that didn't stop. So with that, all the economists, 80% of economists at end of 22 said likely recession in 12 months. And yet we're 2 years in, almost 18 months in, and we're still wondering. And I now am more clear that with all that fiscal and consumers, it might not happen in the next 12 months. It's not a short thing that we'll see a recession. And it might be very light, and it might actually be what people call soft landing, right? So in this environment, you have to be careful. Sorry, going back to the question, which is what do you do? So when there's a big break like what we saw 2 weeks ago, you have to be a little bit careful, right? Because markets having some indigestion on high valuation. There was a leverage in the system which turned out to be a carry trade on hindsight. the carry trade, borrowing from yen and investing around the world, a lot of us thought that might impact U.S. Treasuries. We thought when yen carry trade unwinds, it's Treasuries yields that's going to go up. What actually people did wasn't to borrow from yen to buy U.S. bonds. That would have been your traditional carry trade. What they did was borrow from yen and bought risky assets in the U.S., which turned out to be equity. So the carry trade went into equity. So when that unwound, we had a Nikkei 20% drop. U.S. was a little more balanced by the time it made its way to the U.S., and we were down 5%. Mm-hmm. It depends on the index, right? And then we quickly recovered. I'm glad it recovered, right? I'm glad markets found stability. What surprised me even more is what happened since. We've had a 2-week rally, right? So I
very aggressive one.
Yeah. So usually when you have these V moves, it's trying to set what I think is a sideways move, and the range from which we're going to go sideways. And so I thought we would be done around 5,400. I think what was surprising last week already was announced. Corporates started a turn. About 800 or it's close to $900 billion of corporate buyback program that was approved by each of the company boards were spent. I guess with the year how it went along, a lot of the companies with permission to buy back their own stock didn't get a chance to buy back, so people bought. Nikkei, I'm a big fan of Tokyo, Japanese stocks, and a lot of Americans, actually institutions included, missed out on this rally. They didn't believe in it, and then this correction, I believe, U.S. institutions finally got in. Right. So people actually were able to say when the turn came, I wanted to buy Japanese equities, I wanted to buy whatever stocks in the U.S. So it gave people a chance to buy it back. Valuations are quite expensive. Even at the bottom of 2 weeks ago, U.S. stocks are 4P, the S&P 500 at 4P of 19. So we're probably back to 21. It's quite expensive. Now, having said that, what I've said to investors is, here's a chance for you to buy S&P 493, right? What's happening is tech actually has done tremendously well, but their earnings growth has been slowing down to maybe peaking. It may still continue to grow, but peaking meaning it's starting to fade in speed that they're growing, and their P's are very high. And whereas in 493 stocks, their profit margins have been lagging, suffering, and now they're finally starting to grow.
Do they have? Do you know if they have an ETF for the 493?
No.
They should probably call it 493.
Well, so I tell investors there's two ways to mute your big tech exposure. One is equal weighted, where you own equal amount of each of the S&P's 500 stocks. It's actually I believe it's 503 or 4 stocks, by the way, because the way S&P works. Or in our case, we started to shift from some of our exposure through ETFs when we want to incrementally target certain part of the market. We've been buying S&P mid cap as well as S&P small cap with quality tilt. I specifically talk about S&P small cap and not Russell 2000 small cap, because the issue with Russell 2000 small cap is 2,000 smallest companies, 40% don't make money.
Oh, okay.
So in fact, you can actually already notice that if you take Russell 2000 stocks, break it into companies that are actually making money or actually positive earnings, to companies that are losing money and still remain in the index, you're never going to get kicked out of S&P 2000 or Russell 2000.
Right.
And the companies that are making money are outperforming the ones that are not. So just have to be careful in this late cycle to want to buy small cap. Just make sure you stay quality.
Right. And now for our investors who's interested in the S&P mid cap, is there a mutual fund? Is there actually an ETF
there's
that does
plenty of ETFs that target both S&P or Russell also has a mid cap index.
Right. That's important to know because you think mid cap and you don't realize that the Russell mid cap and the S&P mid cap are two very, very different things.
They're very different. Yeah.
But
and small cap, it's even more different. Right.
That's really useful to know. You said something about late cycle.
Yeah.
And could you expand on that a little bit in terms of, I don't know if the right idea is what inning of the baseball game we're on, but nevertheless, late. I talk a little bit more about the.
Well, like I said, U.S. economy in the last 150 years, where we've been measuring it, has seen 8 or 9 recessions. And what happens is U.S. economy, expands, which we've done, and then it gets late in the cycle, everything gets frothy, and usually something triggers it, or some events, multiple events potentially, that trigger it. And we don't know how it gets triggered, right? We know it's expensive, but then what triggers it? So go back to '08, you trade commodities in your life, right? Some oil traders say oil triggered it. Or others saying the subprime. I forget oil was one. I forget what the other thing, but I'm getting old myself. But in a late cycle, something triggers it, some fear, and next thing you know, everything comes to a halt, and then the credit market is seized. It's really a credit market-driven economy. The world, U.S. has invented this whole credit-driven expansion, and the world has adopted it. So when credit is not flowing, when I lend you money and then you lend it to somebody and the money gets invested, when that halts, then all of a sudden somebody, with the hot potato gets hurt, and then next thing you know, it triggers a negative feedback loop. So in this cycle, I don't know what's going to trigger it, right? We thought maybe last year real estate might be the trigger, then it wasn't. It caused some hiccup, actually, right, as we got into 2023. So if you look at real estate, 22, a lot of even the safer mortgages products, higher quality mortgage products, the spreads widened, the prices dropped, and then it was the best market for those products in 2023. So risk off, risk on. When recession hits, usually people will look backwards at it and say that triggered it. But you don't know until that happens.
Right.
So you get this comment, right? Something's going to break. And then a lot of journalists ask, what's going to break? I can give you a guess, but we don't know. Could be one of 5, 6 candidates.
You make a very good point, and in my trading sort of history, I remember that almost all of the big disasters, LTCM and certainly the Great Financial Crisis, usually they begin and end with fixed income.
Yeah, 100%.
Because the fixed income markets are so big that they dwarf the other markets, and something goes wrong, the cash stops flowing, and it's what Lehman Brothers went bankrupt because they couldn't make. I was with Lehman Brothers when I went down. They couldn't make Monday's payments. They had to declare bankruptcy. Yeah,
and that's when Fed gets involved, because it's not just Lehman goes bankrupt and everybody else gets on with it. The problem with the financial system when one of the broker-dealers goes under is they're all interlinked. It's kind of like a bunch of mountain hikers all, chained to each other for safety. One of them goes down, the others have to hold him up, right?
Right.
Or we all go over the cliff together. It's not that dissimilar to this concept. We're all interlinked. We all borrow from each other, trade with each other. So if one big player goes down, and Lehman was big enough to worry, too big to fail, right?
Right.
Then we all suffer.
Yeah, that's a very good point, because it wasn't Lehman itself, but 3 weeks later, 4 weeks later, Morgan Stanley was in trouble, and then you had AIG getting into trouble, and if an insurance company, as you probably well know, if you can't pay out your claims, then there's going to be a lot of different issues.
So we know that AIG was one of those insurance companies, and for example, when AIG went under or was at risk of going under, the insurance policies were safe, because by law, U.S. have bifurcated insurance policyholders' money. But AIG, the financial company, went under. So none of the insurance stakeholders, somebody who bought insurance from AIG, they were fine. They were not going to be impacted. But it's the AIG financial group that loaded up in huge amount of credit derivatives. And one of the big broker-dealers who are doing very well on Wall Street today was the single biggest counterparty. And they were worried, the Fed, that this would create a trigger impact. They weren't worried about Lehman for that matter, but Lehman, which was a smaller player but big enough, turned out to be still too big to fail. Right.
And the market lost confidence, and it may be if I certainly hope it doesn't come to that. But if we get an issue, maybe it may be multiple things in sequence.
The good news, as I tell investors, as much as I say recession's coming, and the good news is we're not dealing with the financial crisis. So I remind people that in order to see a non-crisis recession where we have some problems to deal with, you have to be my age. Or even, I just started working. Okay? So technically the 89 recession, I was still in college. So 2000 was one of those funky, mild recession. However, NASDAQ dropped 80% in 2 years. So that was a big dent, right? The economy fell a lot harder than the economists would tell you, that the economy was not that bad of a recession, because if you own stocks, you weren't feeling like this was a moderate recession. So it was a severe one. 2008 was a major crisis that hopefully I won't see in my lifetime, right? And so I'm talking about the 89-91 recession, which actually was a ripple trigger from 87 market crash, by the way. And in 87, US GDP grew faster and faster and faster. That's why the stock market was bought. And then there was some dynamic trading program that created leverage. And the Monday, it all came crashing down. And I never really understood what really triggered it. But once people started selling and the dynamic hedging program stopped, then the market dropped 30% in one day. But that was such a severe drop. To finish the year flat, by the way, if you bought S&P at the beginning of 1987, you finished the year zero. You didn't lose money. It's all the people that bought along the way, right? But even there, because it was such a severe drop, it had an impact in consumer spending that actually rippled into a recession. And so you could point to 87 as a reason for 89 recession. That's why when we saw what we saw 2 weeks ago, I thought, is this going to be more or not? Who knows, right? But fortunately, it didn't happen, and we could thank corporate America buyback program.
But shifting focus a little bit, in a market that you probably are heavily involved in, fixed income, U.S. Treasuries. Treasuries have seen a tremendous rally over the past probably weeks and a couple of months. Now it looks like, and if you disagree, I'd love to hear about it. If that the Fed is going to cut rates starting in September. What do you think? Do you think they will cut in September, and if that will be the beginning of a series of rate cuts? And how much do you think that U.S. Treasury, the fixed income markets, have already priced in?
Oh yeah, much of it is priced in for 2 to 3 cuts by end of the year. However, markets like to further get ahead of future cuts as well, so it'll keep going. Now, I personally think we may get 2 to 3 cuts between now and end of the year. There are 3 more Fed meetings left. That's just for simplicity, because who knows, right? A lot of Fed's data dependent, so further data will dictate and change what they do, right? It's not like you can project from here to the end of the year. But I think maybe the fair thing that they're going to do is cut once every meeting. So I'm thinking 3 cuts. But it will all depend on unemployment data. There's some signs that unemployment's weakening. And today, actually, some revision came from the Fed saying they have overestimated year-to-date employment, that actually U.S. employment dating back to the beginning of the year is actually lower. So that, I think, caused a little bit of a surprise to the market today, and yields went down. But the fact that yields barely moved like 2-3 bips on 10-year bonds tells you it's been priced in, right? So I'm thinking September 1 and maybe November and December 1 more each. So we get 3 cuts. I personally we're going to continue to slow the economy gradually. Therefore, I say by end of next year, we could easily be at 375. I think we're going to be cutting about 1.5% and maybe more, depending on, are we going to gradually slow and have a soft landing, or are we going to see something break and it causes a more deeper recession? Nothing crazy, but just more hard recession.
So it sounds like you think that the Fed's going to be pretty careful. Probably not a 50 basis point cut in September?
It's hard to cut 50 just yet because Fed's already, Fed speakers have come out and they've been split. You have a couple that says, hey, you know what, unemployment's going to rise, so we need to cut more aggressively. Others that says, I'm still worried about inflation. Because inflation does have a ripple effect, echoing back. So we saw that in the 70s. So Fed's actually has bad memory from the 70s where they actually had a recession, and therefore they thought inflation will definitely come down in a recession. It respiked even though we were in recession. That's called stagflation. That's like the worst case scenario, where you have a recession and an inflation, right?
I think I was just enough to remember 16% 5-year CDs in 1982 or something like that. But
I'd be hard-bound that we're going to go that high, or even, I don't even think we're going to get back to 9% CPI, so we don't have to worry about inflation running back away, but who knows, right? That's actually what happened in the 70s. It even got higher in the midst of recession. So I think what's going to happen is, I really believe, and this is where the long-term investor has to have a kind of a longer-term view, right? And really you got your finger in the air looking for which way the wind's blowing. I think we're in a structural 3% inflation world, which gets to last year, New York Fed came out with what's the new neutral rate. It shouldn't be 2%. The white paper said 2.5. I say it might be 3. So how far can Fed cut, and what's the neutral rate? And I say we might be looking at 3 in the longer term. But in the near term, we could have inflation go to 0.
Okay. But so it sounds like that when we got used to almost zero rates during parts of the 2010s and right after the pandemic, we may not see those again for some period of time, which may be a good thing.
I think zero interest rates horrible. A lot of bad things happened during that period, including unnecessary risk-taking and returns. So I think the borrowing cost should remain like 10-year Treasury yield. I think the neutral rate, if neutral rate is 3, because inflation is hovering around that, not as we slow, but in terms of next 5 years plus, then the 10 years should be trading 4, 4.5, maybe even, let's go 4 to 5.
Wow, so they've
below
really
that.
Priced that in. We're below that.
Yeah, so. because we're headed to slowing economy. So I think investors are being cautious.
I see. Before I forget, you'd mentioned some of the, with hundreds of $1 billion of responsibility that you have, at least on a fiduciary basis. There are other markets other than equity and fixed income. Do you look at commodities? Gold has had a tremendous run. Do you look at energy? What are your thoughts on that? And
I think, and last year I actually got involved in a book, meaning somebody wrote it based on my input, and I talk about commodity. The whole deglobalization, geopolitics, next decade, lot of factors I think would cause commodity to be in short supply. Okay, everybody's going to have redundant infrastructure, et cetera, right? The world's getting divided. In this world, I think commodities is something that everybody should own, like structurally owned, right? So people talk about 60-40, balanced portfolio, in simple world, 60 equity, 40 bond. That's like de facto asset allocation fund, right? I actually tell investors it should be like 50-40-10, or even 40-40-20, where I think commodity across the board, right? Whether it's precious metal, oil, basic metal, or agriculture, we should own a meaningful amount. Now, at the moment, we're headed towards slowdown. We're headed towards China demand waning. So we need to see this play through, where commodity prices and bond yields are maybe headed lower. But once it flushes at some point, I do believe one should look for an opportunity to structurally, 5-10 years, have an anchor investment in commodities.
For our viewers, how should they get exposure to? What's the best way to get exposure to commodities?
So unfortunately, most of your investors are retail. So you'll have to use ETFs or etc. I don't like features-driven commodities because there's a contango. There's all these futures market where you could lose money sitting there with time decay. So with with precious metals, you and I actually had a offline conversation about that. I buy physical gold and physical precious metals. There's energy and there are certain other aspects. You can't just physically buy an ETF that physically owns oil. Therefore, there I actually lean towards equities of energy companies. There's upstream, midstream, downstream, low-stream stocks, or you can just buy a broad basket, which means it's going to buy more of the integrated oil like ExxonMobil. So I buy actually them in separate buckets. So I've traded OIH, I've talked about it. I stopped trading it from last year, a little too early I stopped. Because I thought maybe slow down would cause it to come down. It's finally coming down now, but I enjoyed a lot of sideways volatility. So one of the things I most actively traded with media involved was OIH in 2022. Okay. In 2023 and this year, it's all been bond ETFs. Because I need something to trade within my value investor range. And oil or some of the equities trade expensive. So for me, my 401k, my broker who manages my equities, they can keep trading it. But for me, when I personally get into something with my money, it's got to be cheap.
Right. Listen.
I'm a little bit Warren Buffett style. When my money market money moves out.
I noticed that Warren Buffett sold, a big part of his Apple stake, and he's sitting on $300 billion of cash and doesn't know where to put it.
Right.
Which probably goes to your earlier point about we're a little late cycle. He doesn't see a lot of value.
Yeah, we're late cycle, and like I said, I say if this market continues for another year, 6 months to a year, which is possible, but I'm not banking on its valuation being expensive. Now, last 2 years, some of these NVIDIAs of the world grew so fast that it was able to digest high valuation. But now these valuations are getting even more loftier, and it's a bigger company where it's hard to grow as fast. And yet here we are, people still willing to pay those lofty PE. And that at some point we've learned in 2000, Cisco, the largest company in S&P, it grew so fast it became the largest company in the S&P 500, traded at 100 PE. The biggest company in America trading at 100 PE is inconceivable. Happened. And I don't think NVIDIA or any of the big tech are anywhere near there. It's just trading rich. It's not like crazy expensive. But having said that, if this economy does finally turn to a much slower growth and profit margins do wane, it will be considered expensive. Now, like I said, if you're in, look at my 401k, I own those things. There's some things you just park and just leave alone. Then there's the trading account. So I'm talking about in a trading account, why would I want to play in something expensive? So sometimes we have to be careful as we speak in these forums. There's the, invest till you really, really don't need the money, or retire, or you can't handle the volatility because you're much, much older, or, right, your broker or somebody's gatekeeping your money, let it be.
That's great advice. I mean,
but having said that, rebalance. So if 2 years ago, 3 years ago, you bought X equities and Y bond, make sure you go back to that original portfolio in weight, because equities would have grown faster.
And you can see NVIDIA from the low a couple of weeks ago. I think it's rallied 30%. Looks like the market likes it right into earnings.
Sure.
I'm a little afraid to what happens when one day NVIDIA only maybe just meets earnings. I think it's you might have
hasn't happened yet.
Get the young kids off the streets.
Right.
But we may see shortly.
Cisco 5 years, therefore 20 quarters beat to the day that it, today you haven't even gotten back to that peak 25 years later.
Wow.
So that last guy who bought it at the peak, if he still holds it, he still hasn't made his money back. I'm just saying, but those are extreme examples. Yeah.
You know, you mentioned earlier, and I wanted to get your view on, you know, sort of the more private equity, private credit, maybe even commercial real estate, where a lot of money has gone into, and I don't know if that's something, you know, something that the insurance companies might actually get into, because the, you know, the returns could be good and the profile is very long. There, you know, there have been concerns about those markets, in part because they don't mark to market very often.
Right.
Do you think some of those concerns are legitimate, or you know, or this is just, you know, folks in the financial media looking for something to write about?
It's mixed. You're taking liquidity risk, okay, and you're collecting liquidity premium, and it's hard to measure in price liquidity. Okay, liquidity risk, we talk about it, and somebody says, you know, how do you measure it? How do you describe it? It's hard. Liquidity premium or risk can be measured if you're forced to sell. This is the baseball analogy. If everybody wants to get out because they think the end is there, right? Baseball game's coming to an end, or economy's cycle is coming to an end, and everybody wants to get out, it'll be very quickly measured, because then people are going to sell it at a discount. It's kind of like close-in funds for anyone that's traded close-in fund, right? They usually, close-in funds have an actual clearing price and an NAV, its value. And during periods when everybody wants it, you have to pay a premium. Like it could be as high as 20% premium. During recession, or as you get into recession and people want to get out at any cost, it trades at a discount. Actually like 20-30% discount. That's, now you can measure liquidity risk. But having said that, some of that risk, if you're willing to just leave it alone and your underlying is sound, then you just have to live with the fact that you can just put that away and wait for it to come, the markets to normalize. That's what insurance companies can do. We have a long liability. Therefore, we don't have to have that money back now.
Right.
Right?
Right. Makes sense.
But for us, in order to be able to be patient, you have to make sure you're investing in a company or lending to a company that's going to be money good. Sometimes you have to sell at any price, not because of urgency of liquidity, but because that company will go to zero because it's going to go bankrupt. So that's why insurance companies generally invest with a conservatism in who they lend it to. Because during crisis, they know that most likely this company is money good, or you can figure out a way to get your money out.
Right.
Okay? Subordination, like collateralization, right? When you lend to somebody, you need to make sure if that guy doesn't pay you back, he's got something that you can take from him legally, of course,
right.
And get your money back, right?
You want to lean in some way on something. Going along on that same the same focus, we've talked about U.S. bonds, U.S. Assets. Are there parts, and particularly since you're chairman of New York Life Investments in Asia, are there international equities, or any countries that you particularly like? I think you mentioned a little bit earlier you like Japan.
Yeah. I love Japan.
Tell us why you love Japan.
Well, so due to my travel to Asia, I go to Korea, Japan quite a bit, and occasionally, less frequently, to Southeast Asia or rest of Asia. And I think Kishida, when he became Prime Minister, came here in late 22 to talk to us about the reforms. I paid attention because that's my client market. But then as I track, follow, visit Japan, I realized there's a structural change coming. The 30-year sleeping giant is awakening, 1. 2, you have to believe the next statement. U.S. in the 80s and 90s saw Japan as an economic enemy, wanted to halt its expansion to grow bigger than the U.S., then shifted its focus to China. In the last couple of years, since Trump actually and Biden followed through, so both Democrat and Republican administration said China's the economic enemy, right, or challenge China's growth. And I think they want to move away from China. They need Japan. So this kind of gets at, you have to believe in this. This is not something that it's something that I strongly believe is happening. So U.S. needs Japan to get strong again.
You said that the sleeping giant is awakening.
Yeah.
I just see that Japan has population issues. They're not having enough children. What makes what is causing this giant?
By the way, Japan is shrinking faster than other developed markets. Europe, Korea, China, they're all shrinking. In fact, U.S. would shrink other than we have a great immigration policy. And even in the last year and a half, the other thing other than fiscal that surprised us is the reason inflation was able to make progress is, it's underestimated number of how many immigrants were allowed in, whether they jump over a fence or got off a plane. 3 to 4 million people entered the workforce. And so there was a huge supply of labor into the country.
Right.
Yeah.
Now, and you love Japan.
Oh, sorry.
You like Japan.
Demographics is bad for all of us.
Right.
Other than countries like U.S. where they have a good policy, immigration policy, good or at least forgiving. Right. I don't know if ours is that quick. But having said that, Japan actually is corporate action, right? Kishida forced corporate Japan to have a better shareholder value. So anybody with a price book below 1, you're going to get kicked out. So you better have a plan, or we're going to kick you out of Tokyo Stock Exchange 1. They're forcing corporate Japan to delever their cross-shareholding. You buy my company, I'll buy yours. Like there's some of that incestuous relationship going on that's being unwound. I think China policy, U.S. policy against China, more supportive to Japan. I think that's it's like an invisible hand concept. It's not easy to see, but it's happening. So Japan actually is starting to turn. And also weak yen, the tourism was the spark, right? Anybody who's been to Japan, or let's go the other way, anybody who hasn't been, there's fewer number of people that hasn't been, probably in terms of people that like to travel. You need to go now, before the yen heads back to, before yen tucks itself within the range of 125, 140. I say to people, eventual long run, yen should trade between 125 to 140, then got to 162. Now it's gradually heading towards 140 as BOJ hikes. And it will continue to hike into next year. You better, get your last chance to go to Japan where the yen is still on sale.
That's amazing. So, I remember
Japan is turning.
I remember trading dollar yen at 80.
Yeah, that's 2012.
So remarkable, and even before that. So Japan a good location for.
I think Japan's structurally a good investment.
Okay.
Any
other ones?
I think just about anything these days, whether you're looking at treasuries, bonds, equities, in my mind, in this gradually slowing economy, if you believe in that thesis, this valuation is kind of high in gold. Just about anything is expensive, right?
Sorry, I interrupted. You were saying the forward PE in Japan is how?
Oh, the forward PE in Japan was 16 before this break.
Okay.
So maybe it's now, we rebounded maybe half or 2/3. We're back to in the May levels today. So maybe it's 16 again.
Okay.
Yeah.
16 was quite
versus a bit. US being 21.
Right. But pretty good value. It's another 30% of value.
Now inside US equity market, S&P is 21. Inside that, if you strip the 493, there are certain segment of the US equity market like mid cap or small cap. Historically, it's relatively much cheaper. Now, small cap, I can understand why it's trading cheap, right? Because it's not done well with Fed hiking. With Fed cutting, we're starting to see signs of, positiveness in the small companies. Just stay quality.
Right.
It's still reasonably cheap.
Shifting a little bit, one thing that the Democratic National Convention is happening this week in Chicago, and it looks like it's going to be a very close election for president at least, and actually also very close in the Senate and the House. And I think Americans don't know which way it's going to go. And I think a lot of our international viewers may have questions. Is there a trade for a Harris win where you think there might be value versus a Trump win, or is if you had a strong feeling one way or the other, is there a way that you could play one or the other?
There is. So there is clear trade that people have identified, right? But here's the key. When Trump-Biden debate happened and Biden had a poor showing, there was a huge backup in yields because it's not just Trump winning the election by itself. It appeared that Republicans will have a sweep. Okay, they have the Senate. Oh no, they have the House. They have a split on the Senate. So Harris, the vice president, is the split vote, and then you have the Democratic president. But there was a moment in time after that debate that looked like Republicans would sweep both presidency, House, and Senate. That's scary because once you have all three, you can pass law. Then when Harris came in, that trade faded and yields came back down because then there was a split government view. If Harris wins with a split government where Republicans own House and Senate or House or Senate, then you have a split government, which is what markets generally like better because then government has harder time passing the law. Now, all this is going to constantly change, by the way. Now there's talks of Harris sweep, or maybe Harris might be able to turn sentiment to owning the presidency, House, and Senate. Then she can pass law easily. So I think the markets won't be that bothered with a split government because it can pass only so much law, but new law. But if there's a sweep, then you have a lot of power with the president.
I see. So almost a steepener, if it's either party sweeping, because then the parties will do what they want, which for both parties now it seems like spend money.
Yeah. Well, yeah, no, there's no doubt. It's where they spend it and how they spend it. Trump, despite his voice, I think his policy favors the wealthy. His tariff-driven agenda might support U.S. manufacturing and the blue-collar workers, but net, his corporate tax policy, etc., actually favors the wealthy, right? That's why a lot of the wealthy like to go with Trump. Then with Harris and Biden and Treasury Secretary Yellen, it's clearly an element of social program that's involved, right? That's the way their stance is, right?
Well, thank you so much for coming on the show.
Sure.
For helping us launch our
right.
international program.
Yeah.
Look forward to talking to you again.